We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodjevics. Joining me today is Michael Oliver from olivermsa.com. How are you today, Michael?
I'm fine, Tom. How are you?
Excellent. Great to have you back.
Good.
So you say a lot that short-term events are to be ignored, and your charting style many times uses longer time periods and doesn't just look at price. So can you give our listeners a bit of a refresher on what some of your most valuable tools are that you use to analyze the markets?
Well, we generally look at, like you said, long-term. And by long-term, what do we mean? Let's start real long-term. 3-year average, 36-month average of a market. Okay, it's something that's very glacial in its adjustments. 36-month average is usually what we use, which is a monthly adjusted 3-year average. And we plot a market, the price of a market, in relationship to that mean. You know, is it above it? Is it below it? And it creates an oscillator that looks different from a price chart. Quite often will look different. Sometimes they'll look the same, but usually near tops or near bottoms, you'll find that the momentum tends to deviate and build different looking trend action than does the price chart. And so it usually gives you a warning that the big picture is about to change. But then we also look at lesser long-term indicators like quarterly momentum, which would be 3-quarter average, 40-week average, similar to a 200-day average in duration. These are also sort of long-term. And we measure price in relation to that. And sometimes when you change your time scale of your yardstick, in effect, you get a slightly different picture with slightly different trigger numbers. So it's like for instance, the other day, we came out with a report on the S&P and the Nasdaq, and we defined numbers in the weekend report that if they closed Monday at them or below these numbers, they would break weekly momentum down. By weekly momentum, we were using a 3-week moving average, a 15-day average, 15 trading days. And that's fairly short term. And why did we look at that? Because we usually don't look at such short-term things. The reason we did is we know that if the short-term stuff breaks down, if it drops too much, such as 4 or 5%, if it causes that kind of drop, it could trigger another larger domino to fall, such as monthly momentum or quarterly momentum. And that's the case with the stock market right now. That's why we're looking at short-term, because we know if one little domino falls, it might hit a bigger one and a bigger one in cascade. We think we're in that situation. So we look at different time scales, but yes, the emphasis is on the bigger picture because we don't, what happens week to week sometimes doesn't really, it's just noise. And you shouldn't put too much on it unless it's causing something to happen on a longer term technical nature.
So considering that exactly as you're saying, the Nasdaq, Dow, and the S&P are all right near all-time highs right now, how do you use your analysis to try and inform what could happen from here? Obviously, there's many people that are warning about a crash, and I'd like to get your analysis of that situation.
Well, frankly, we wouldn't be looking for a crash. Yes, we had a crash last year, and it's rare to have a crash year to year, back-to-back years. Okay. Also, another fact of American stock market history is there's never been, to my knowledge, a bear market that began with a crash except for 1929. Where you started with the crash, you had a 50% rally into 1930, back up toward the high. And then you went down for 2 bloody years of arm wrestling decline. Never crashed. Started with the crash, but ended with just an arm wrestling consistent decline. Hardly any emotion in the decline. It wasn't big chunks. It was just arm wrestling and wiped the market out. But you look back at 87, for example, we had a crash. That was the bottom. It turned up again. Or last March, we had a crash event with 35% drop in a matter of days or a few weeks. And what happened? You turned up, made a new high in most indices. If we're topping now, and we think there's a good chance the market is topping, meaning a significant high that lasts a while. We don't have the evidence for that yet. All we have right now is a breakdown in near-term momentum that says expect a sell-off. The problem is, like I said, if it's of like the 5% variety, which is not a big deal, you could topple into something bigger. I could break some quarterly momentum factors. And that then suddenly you're talking bigger picture. But I suspect if we are topping, that your leadership is now still the leadership. That is to say, the Nasdaq 100 front end of that index, which, as you know, is Microsoft, Google, Amazon, and Apple. They're so heavily weighted, they constitute 50% of that index. And even in the S&P, they constitute like 20+%. So those are your leadership symbols. And if you'll notice, they've pretty much stalled for the last several months while the market S&P has gone up more and some other indices, sectors have gone up more to sort of catch up. But the leadership has wobbled, not dropped sharply, but certainly not gone up. And so when your leadership wanes, you better pay attention. Unless you believe, oh, some new leader is going to come along and supplant it. We don't buy that. We think if the leadership is topping and is in trouble, that it will take the market down with it. Now, the rate of decline we think you could get out of the Nasdaq 100, for example, assuming we topple some bigger numbers, is going to be greater than the percent decline you might see in the S&P or the Dow, because they're not so heavily weighted with the, quote, leaders. So we think you could get a sharp, like a 20% plus drop in the Nasdaq, assuming we trigger some of the numbers we're looking at, which we've not done yet. But you're not going to get that same kind of dimension out of the rest of the market. They'll follow it down, but it won't be as big a deal. But it's the better way to start a bear market, if you ask me, because that way you don't announce it at the beginning, that, oh God, we're in trouble. Instead, let them think it's just a pullback. And then give them a rally, but the rally doesn't make a new high. And then you have another sell-off. And, 9 months after the high, suddenly you're 20% off the high and people are wondering what happened. Ambush them that way rather than with the crash. Because crashes usually don't begin bear markets.
So, Michael, are you kind of making the parallel to, let's say, the 1929 crash and the crash that we saw last March, and then we could possibly see this arm wrestle back down with slight corrections in it? Is that something you could see coming?
If I had to bet on that, if we're topping, and I think there's right now we're starting to get some evidence of that based on weekly momentum. Right. If it topples into quarterly momentum, breaking structures on our momentum charts that are measured by like the 3-quarter moving average or a 40-week average, which is significant duration, then the odds are you're making a top. Now, we also look at other asset categories and look at them, just look out the windshield at your market. Look out the side mirrors to see what the other asset categories of significance are doing. And if you'll notice, gold peaked in August and had a layered zigzag decline of 17, 18% at the worst. I think it's probably down about 15%. Took it 9 months to get back 15%. Everybody thinks it's the top. Okay. Silver during that time has gone into a sideways range, and T-bonds have gone down with gold, meaning yields have risen while gold has pulled back. So when you look at the charts, you circle the S&P, let's say in early August, you go up and to the right. You circle the T-bonds, made weekly closing highs then in early August. Gold made weekly closing highs, and they go down. So they're inverse to the stock market now. That is the T-bond futures, T-note futures, TLT, the ETF that's very popular, and gold. They've all been trending down while the stock market's been continuing up. If the action we see in the T-bond market screams at us that this is probably a bottom that could generate a very sharp counter trend rally, meaning that even if we saw a high in T-bonds, the low in yields, we think you could get such a sharp rebound rally, why would that occur? Well, asset managers, basically large asset managers we're talking about now, that manage tens of billions and more. There's the U.S. stock market's one big category, U.S. government bond market's another. We're not talking high yield debt now, we're talking U.S. government bonds, and gold as alternatives to the stock market. So if they start to move money out of a nervous area, they got to put it somewhere else. And evidence of the last few years is they tend to put it into T-bonds, T-notes, and to gold. And we're seeing bottoming action in gold, seeing bottoming action in T-bonds, topping action in the stock market. So they're all doing the opposite. So we'd also watch what the T-bonds do and what gold does in the next weeks in terms of estimating whether the stock market is topping. Because if all three start to flip their trends, it's a chorus. It's telling you something. And I think that's what we're beginning to see.
So as you're talking about these let's say bottoming formations in gold and T-bonds, Michael, are they somewhat of the same indicators that you're using to kind of look at the topping formation in the S&P?
To a lesser extent, because the pullback, for instance, in gold has only been of an intermediate trend quality, meaning it didn't jeopardize whatsoever our annual momentum trend measurement of the gold market. We actually got bullish on gold first in February 2016, $90 off the bear low. The bear low was about 1050, and it rallied up to 1140 in February of 2016. And when it got above 1140, we turned major long-term bullish, not because the price was doing anything particularly obvious in terms of breaking out, but annual momentum was doing something very clear. It was a massive multi-year ceiling it was breaking through. And so momentum said, that's the bottom. And then, of course, gold loitered for several years between, the high 1100s, mid 1100s, and summer of 2018, it pulled back down to about 1160. But basically, it was between the mid 1300s and down below 1200. It was in a zone, but it never went back to its bear low. Okay. And then in 2019, it emerged more fully. And obviously, you've been on the price charts. And it did it without any help, really, from any other markets. In other words, you didn't have a commodity upturn at that point. That didn't occur till about 3 quarters ago. You didn't have a weak dollar at that point. Gold on its own said, I'm going up. Things are going to change. And so a lot of people who look at gold looking for reasons, this is happening, therefore gold will go up or go down. Flip it around the other way. Gold's the leader, not a follower. It's the oldest market in the world, the traded market in the world. If it's got wisdom, that's the one to look at. And so rather than looking at the dollar for reasons to buy gold or looking for commodity price inflation, those lag gold. We're now starting to get a weak dollar. Gold didn't need a weak dollar all during the last couple of years. It doubled in price. And the commodities lag gold on the upside. They only turned up late last year. So, but in terms of gold, no, the long-term technicals were never in jeopardy, were never an issue in this pullback. It was just a pullback in a long-term trend. The only thing that broke were like weeklies and some monthly stuff broke. And therefore, we're looking at those time scales of measure. What does weekly momentum of gold look like, for example? What does monthly momentum look like, measured against a 3-month average, for example? What does the momentum structure look like? And they're turning positive, which is echoing what the T-bonds are doing, and inverse to the stock market.
So, Michael, I'd like to go back to something you were saying about basically the dominoes that they were starting to get or could start to get tripped. Do you think that the trading algorithms have anything to do with that as well, or is it simply from your perspective the momentum? Let's say weekly momentum tripping into monthly, tripping into quarterly?
Correct, right. The momentum oscillators that we watch, that we monitor, and what we do is when you see a momentum chart, it's a bar chart like a price chart. It might be a day bar, a weekly or monthly bar with a high, low, and a close. But instead of against a price scale, it's against plus or minus numbers, percentage above or percentage below the zero line being the average that we're measuring it against, 36-month average, 3-week average, whatever. We don't pay any attention to other notions outside of that in terms of what might be impacting or causing these various timescales to develop their trend structures. We put blinders on. We have our own fundamental assessment, and quite often our fundamental view is in sync with the technical. Sometimes it's not. We turned major bearish on gold in early 2012, a couple months off its high. We stayed bearish all during 2012 and didn't turn bullish till 2016. And yet monetary expansion continued during that time, not rampant, but it still continued at its normal double every 10-year rate. And yet gold went down, and we were bearish because of the annual momentum broke down, not because of some reason we could cite. And we can cite plenty of reasons right now that have lagged gold that now sort of explain after the fact, oh, gee, commodities just exploded, et cetera. But if you look for those ahead of time, it's a debating society then. We don't want that.
Yeah, that exactly goes back to your point of pointing towards, reason A or B for gold going up or down. It's, the chart tells you everything you need to know, and you just need to look at it over the proper time scale, right? Yeah,
and not all the time scales will be in sync with each other. In other words, you might have a market that's going down on a weekly basis. The weekly momentum's negative, maybe it pulls back for a couple of months. But the long-term trend is not affected by that. So you get a positive on your annual momentum and negative on your weekly. You have to fit them together as an investor or a trader. If you're real short term, you don't care about the annual, I guess. But right now we're concerned about the long-term trend because we think what's going on in the long-term trends of these markets is significant and likely to get really significant and evident to everybody later this year and into 2022. And have some very dramatic market movements, and not just in gold, but in a lot of markets.
So speaking about exactly that, Michael, we recently saw, a good spike in interest rates that a lot of noise was made about. What's your longer term view on interest rates, and how do you see that market developing?
Well, right now, if you're short the T-bonds, expecting the excitement about higher rates to continue, I think you're about to get stabbed, okay? And I think the rally could be fairly severe and short, meaning it might only last a couple months. But if you get a sharp upturn in T-bonds, like for instance, the T-bonds hit an intra-week high, I think, of 195 on the futures way back in the spring. And in the summer, they made their high weekly closes and so forth in the 180s, T-bond futures I'm talking about. Then we dropped down into the 150s recently, okay? We think you could rally T-bonds futures back up to 170, 175 and do it in a couple months based on what we see in the monthly momentum, not annual, not quarterly, just the monthly. It says hey, you could get a sharp bear market rally if you consider bonds to be in a bear market. Now, you could still get a sharp counter trend rally, and probably our bet would be that that's due to some asset reallocation out of stocks into what's perceived as safe. Ultimately, the bonds don't look that good in the long run. They look like after this next rally, so when we get it, and I think we will, which will disturb the shorts, of course, if you get that rally. At that point, you need to reassess T-bonds in terms of a long-term downtrend, meaning higher rates sustain over time. And I think at that point, you're going to get a divorce between the linkage we now see that's positive between T-bond futures, T-note futures, and gold. So if you get a T-bond rally right now and drop in rates again, you're going to get a gold rally with it, is our bet. But at some point, they're going to divorce. And I suspect that might occur later this year, where after a T-bond rally, T-bonds start back down, gold doesn't. And at that point, T-bonds link up with the direction of the stock market. Meaning higher rates is not good for the stock market, but you get higher rates. Why do you get higher rates? Because, they're pumping money like crazy, and commodities as an asset category are still vastly underpriced. And so you're going to get, what people call inflation, meaning rising commodity prices. And therefore, we're back sort of in a late 1970 mode, except even more exaggerated than that one was, because of the monetary policy is far more exaggerated than that one was. Of course, that brings up another issue that's not talked about too much. Everybody's worried that the Fed at some point is going to let off the pedal because, too much inflation or something. They get their 2-point plus CPI or whatever, nonsense indicator. But anyway, I'm sure Powell will not do that at all if the stock market becomes a negative. It has not been a negative for the last several quarters. It's not been a dark cloud. It's not been a psychological negative for everybody. And even people not in the stock market are affected by the stock market. If you've got a medium low income job and all of a sudden the stock market goes down and your company's stock starts to go down, you're worried about getting laid off. You've been there before. So the stock market affects everybody psychologically. And if it becomes a negative, you can bet that the Fed policy is not going to stop. I don't care what commodity prices are doing.
Yeah, that's a great point, Michael. And I'd like to go back to something that that you've touched on a couple times here, and that's that traditional relationship between, let's say, the T-bills being, at sometimes they're inversely correlated to gold. Right now, they're correlated to gold. So why does that relationship flip-flop?
Well, I think ultimately the bigger issue is, if you have inflation is measured by most people, have whether that's a commodity and CPI type stuff. And especially, I think it's not an issue so much of what the Fed does, although they're providing the fuel and the river flow. It's what the investors do, especially asset managers who've been around a while and who know how to move assets from category A to category B. And they've learned that, you need to do that. Some of them haven't learned that because they're young and they don't have good memories. But those with memories, like, Ray Dalio in recent months has come out, with statements saying that, don't worry so much about your investment, worry about your money unit. So, that's the fundamental. And so I think we'll get, if we get more into inflation and we get the sense that it's not temporary, as they like to suggest it might be, and we think, it's more lasting than I thought, or it's more serious than I thought. At that point, that will cause the fundamental of inflation to hit the bond market. And right now, see, too many people think, we're getting the inflation, but it's temporary. The Fed's under control. They got a control over this. So don't worry about inflation. Yeah, right. When that perception mellows and it goes to, oh God, we got real inflation and it's going to be here for a while, that's when the T-bonds, I think, will shift into a long-term trend. And they have the structure to do it, meaning to go down and go down big. For instance, the recent pullback in T-bonds, while it broke quarterly momentum to the downside and monthly and so forth, and you produced a nice decline, it then got very oversold by our metrics, and it landed on the 36-month average. It came down to the rising 3-year average, 36-month average, and that's basically where it's been basing right now. So if you turn the T-bonds up for several months off of that inflection point, off of that mean, very long-term mean, and then later you come back down through it, that will be a major momentum technical violation. So a rally right now on the T-bonds that lasts several months and impresses people, takes rates back down a bit, will actually be a potential major negative in that it will have set up a structure. There was a pivot point off of a key moving average such that if it ever comes back down through that rising moving average, it will turn negative. And I think that's what the rally is. One of the purposes of the rally might be is to set the structure. One of our slogans is, you can't break a trend unless you have something to break. And usually that something is evident on momentum more so than price.
Interesting. So exactly as you were saying there, Michael, when we're talking about our money unit or our currency unit, how do you think is best to conceptualize for our audience the metric of, let's say, measuring the dollar going down? Should we measure it against the basket of currencies that the DXY measures, or is it inflation? Like, what do you think is the best way to conceptualize it? I did a recent interview where with a fund manager, him and I were talking about maybe measuring it against a basket of commodities. Might that be a better way to think about it?
That's a good way. We do that because we measure like the Bloomberg Commodity Index versus the dollar. It's the same. You could reverse it if you wanted to, but it's clearly broken out over annual momentum structures. You go back 5 or 6 years, a ceiling, where it kept going to the same level on the momentum chart, and finally it blew through. And it's not quite so evident on the price chart. Price chart just got a nice rally, and you might be able to say, well, just another rally. Okay. Annual momentum says, no, it's not. You saw the low. We're going a lot higher. But all those things you mentioned are valid ways to measure the money unit. You measure it versus other money units, but you have to remember that the euro is being inflated, the yen is being inflated. Now, it's true that as many non-gold bug asset managers, like Ray Dalio pointed out, it's being inflated more rapidly than even those currencies are. So the real culprit in the world is not the emerging market currencies, it's the developed market currencies, but especially US. Our rate of monetary expansion is far outpacing the Japanese or the Europeans. So we're really, in terms of measuring it versus them, for example, in the dollar index, that's a way to measure it too. But again, you're measuring against other degrading currencies as well. We're just degrading at a faster pace. And so we see the dollar now challenging a low. It's made a low in 2018 at just below 89 on the dollar index. Went back up over 100 again. It had been over 100 already at that point in 2016. Dropped down under 90. Went back up to 100 again. Back down January this year to where? Around 89. Mm-hmm. Took a 4 or 5 month rally. Finally got up to 93. Right now, where are you now? Back down in 90 area. It's our view, if you ever get to 89 again, forget it. That floor that they're defending on the price chart, which actually goes back to 2017, where there were a couple highs at around 89. So we're sitting on the old highs. If you break through that, even on the price chart of the dollar index, annual momentum of the dollar index already broken, but the price chart itself will then break through a clear floor that any idiot could see. And at that point, you're likely to pick up pace on the downside. But again, you're measuring there against other elastic units of measure. They're just not quite so elastic as ours is right now. And measuring against commodities is a valid way. Measuring against gold is a valid way. You got one money unit that's been around for thousands of years and another money unit that's been around for 100 or two, and which is proven to be highly elastic. So all those measures are valid.
Yeah, it just seems like when you're measuring it against other currencies at this point, it seems like a race to the bottom relative to free fall speed, right?
Well, and also, the St. Louis Fed used to put out the M2 charts every couple of weeks, money supply too. Well, M2 used to expand from 1959 up through a year ago. Almost doubled, not quite, every single decade. Yep. If you just count on it. It might be variances during the decade, but basically every decade was about a 90% increase in the quantity of the dollars out there. And now suddenly that's gone out the window. We do that, the pace is unmeasurable. So, you can measure it by the M2 chart, but unfortunately they've decided they're going to discontinue the M2 chart. I wonder why.
Seems somewhat convenient, right?
Yep. It don't want to show the truth. The Wizard of Oz is behind the curtain.
So, Michael, I'd like to go to something that you were talking about in one of your recent reports. And you said that the main point is not to confuse a stall or correction with a top. This is a fresh, massive annual momentum upturn, as is the case with commodities in general. Monetary inflation-driven asset class shift is freshly underway. This was at the end of an analysis you did on sugar. So why can we look at sugar as representative of most agricultural commodities?
Well, they're all pretty much, you could throw a dart. There's some that are lagged a bit, like coffee is a bit lagged, but it looks good to me. Looks like it's made its bottom and there's a lot to go up. They don't all move in sync, but boy, did a lot of them move in sync since late last year. We used quarterly momentum initially to turn bullish on Bloomberg. And we turned bullish on Bloomberg in the high 66s, low 72s area on the price of the Bloomberg Commodity Index. And then the quarterly momentum breakout caused the annual momentum breakout to occur as well. But when we look down at the components of the Bloomberg, and they're weighted differently, by the way, Bloomberg reweights its, how much is gold in the complex, how much is silver with copper, et cetera, and they shift them around a bit. So some of these soft commodities like sugar and cocoa, and I don't even think cocoa's in the Bloomberg, and coffee, they're not ranked real highly weighted within the Bloomberg. But nevertheless, you could have thrown a dart at corn, soybeans, wheat, sugar, copper, crude oil late last year, and they all exploded at once. So you can't say, oil went up because OPEC did this or that or something, related to oil. How come they all went up at once, virtually like, somebody unleashed all the horses and opened the gate? It's a monetary issue. Plus, they were all too low for too long. I mean, if you look at the commodity complex like the Bloomberg, basically it bottomed in 2016 and went sideways with some minor ups and downs for 4 or 5 years. And it made one more spike low in early 2020 in that March sell-off that lasted all of the few weeks, so nipped out the prior lows. But basically, commodities were saying, we've been beaten off the page since the 2011 high, which was when gold peaked, by the way. And we've been punched and punched and punched, and we're not going to zero. And so what you got was this big sideways action that just bored everybody to death. So every rally seemed to never go. But then when momentum broke out, the rally went. And as far as I'm concerned, when you break an annual momentum trend of clarity, when you look at the momentum chart, you say, oh boy, because if you saw a price chart that looked like that, you'd get very excited. Those things don't last for a few months. They last for several years, sometimes 5 or 10 years. And so this thing just broke out quarters ago, not years ago. And so, our view is that when you get an annual momentum base breakout that we've had in commodities, don't expect it to go away. Yes, you're going to have pauses. And frankly, in March, we thought commodities would pause for a while because they had too much too quick. Their initial inhale on the upside was like a beach ball. You push it underwater and let go, it goes whoosh. It went too far too quick. And so congestion, it makes sense. And then we've seen that. You can go back to February in some commodities and draw a line sideways. And they're holding their gains, but they're treading water. Once they've had enough pause there, they'll resume again. And we think that'll probably be evident by this summer, that you'll have another resumption up in commodities. At which point, probably the commodity complex will then look like it's in sync with gold, which it will be. It's a major event, and it's not likely to be brief.
So do they include lumber in that commodity index as well?
Good point. I'm not sure whether they do or not. I can look it up, but it'll interrupt us. I'm not sure lumber's in there. I think it is. And yes, lumber went ballistic. Lumber did have some interesting, I think, implications that are above and beyond the inflation issue. And I think it's an issue of, we see an economic downturn coming, not the virus downturn that we saw that the stock market said, oh, buy that and take it up, because the Fed's going to print money, and sure enough, they did. But something more malicious and malignant and long-term, where a lot of the debt that's been generated because the Fed wanted people to spend, not save, explicitly stated this. Bernanke even wrote papers on it. Creates a situation where individuals, governments, corporations are not in the position, savings-wise versus their debt, to handle a downturn. And if you give them a downturn now, and look at the 12-year upturn in the stock market, for example, that's a hell of a chart. If that thing breaks, you look at the price chart, you don't know where support is. Why? Because it's been too vertical. There's not even layers hardly. If we break the stock market down, you're going to expose all kinds of malinvestment that have been built up over the last decade or more, caused by monetary policy, which encouraged certain behavior and discouraged other behavior. And when you rip the scab off, and the stock market might be an emotional way to do that, you take it down to where people are convinced, my goodness, it's going down, it's for real. These other errors in judgment, individual, corporate, government spending, et cetera, will be exposed. And that will create social ramifications. And I think on a gut level, a lot of people with wealth who live in large urban centers, in wealthy townhouses, on upper floors of buildings, expensive, multi-million-dollar apartments. Suddenly the wife comes home and says to the husband, I feel unsafe out there. I heard the news tonight about the shooting over here, or the riots here, or the burning, and they have a gut level nervousness. And I'm not talking there of a political stripe one way or the other, because I think it's pretty broad. And they've got the money, and they just say, we're getting out of here. So where are they going to go? Okay, well, they go to the suburbs. Maybe it's nearby, or maybe it's Florida, maybe it's Utah, maybe it's northern Colorado, where I am, And all of a sudden, there's this inordinate demand that wasn't expected for housing. And the problem is that the number of homes already built ready for their occupation wasn't sufficient. Just weren't enough of them out there. And so they crowded that market out. Now they're going to build. And so there's a massive demand for building by people who can afford to build without really caring too much about the price. It's a major life decision. They're getting out of there and they're going to there, getting out of high tax states, going to low tax, getting away from urban centers, a sense of safety. I think to some extent that is a correct fear on their part, an anticipation of something's wrong. And I think that something wrong is going to be exposed separate and apart from the virus. Once the virus is out of the way, we're still going to have it. And therefore, the lumber explosion that we've seen, remember, lumber used to be $100, $200 range. Now it's in the, $800. I don't think it's going to come crashing back down anytime soon. I don't think it's necessarily going higher, but I think it could actually sustain up there for another year or so as this person-to-person shift continues. And I think if you take the stock market down some, that'll help encourage even more people to get the heck out of where they perceive to be unsafe places to live into safe places, and therefore demand for lumber. So to some extent, it had a different type of excuse that may persist for another year or so.
I saw an interesting tweet that kind of summarizes that. And if we do, if we do see the stock market grind lower, it's very likely that we're going to see the house bubble start to unwind as well. So the tweet was, the guy was kind of conceptualizing, at what point does the lumber that my house is made of become worth more than just having my house as a complete unit? Yeah.
No, I'm not sure about the housing bubble. I think that it's supported now not because of a, quote, strong economy, which a lot of people would like to say, oh, yeah, housing market's strong because the economy's strong. Yeah, it could be the reason I just explained, that's really your underlying reason for that sudden wave of demand that nobody expected. Certainly the home builders did not expect it, nor did the lumber manufacturers expect it. And so, there's this catch up. And therefore lumber's exploded and base metals have exploded and copper piping and so forth and so on. I'm not looking for the housing bubble to pop right yet. I think you probably ought to look at lumber for that. And I think it could be artificially kept up for that reason for a while longer until that demand to shift from unsafe to safe place is sort of satiated. And once that occurs, then you might see the housing bubble drop, because the housing bubble is inflated by those numbers. And that's probably temporary, but I don't think it's this week. I think it may last for another year.
Interesting. So, Michael, when you were analyzing the XAU specifically, you were saying that gold and gold miners simply don't have annual momentum structures nearby or even constructed yet to break down through in order to generate a sustained downside. Can you explain more to us about this, please?
Yeah, again, that's a visual. And where when you look at a price chart, well, first, let's put it another way. Let's forget momentum for a moment. If you just look at a gold chart, you had this collapse in 2011 through 2015 from 1900 plus to just above 1,054, I think it was. And then you had this leveling off in a box. And even on a price chart, you had this range roughly with highs, multiple highs in the mid 1300s. We went up like 3 times into that level and just got distributed into, went back down, never made new lows. But you just went into a range. It's sort of like what commodities did. Commodities were lagged in their breakout. But even if you just look at the price chart of gold or the price chart of silver, silver had a gradually declining base where you had a rally. Once you got down in the teens, you had a rally up to like 21 plus. It's about late 2013, I think. Came back down again, had a rally up to 20 or so, and then went back down again, had a rally up to 19 in early 2019, I think it was. So you had like 3 highs, a very gradual decline, but basically a flattening action by silver. It was 5 and 6 years wide. Now, why on a price chart would you have gold with a base that wide and silver with a base that wide and tame and solid looking? Explode up out of that base and then say, oh, I'm going to top now. I mean, you got a base that's a half a decade wide and you break out of it. Now you think it's topped. I mean, that's the biggest base gold and silver have probably ever built since gold became legalized in 1975. So even on a price chart basis, the bigger the base, the bigger the move. And yet when we got up to $29 silver, everybody thought it's the top, it's no good. And gold's no good, it's going to collapse down to 1,000 again, whatever. And we could not see anything when we looked at our long-term momentum charts that said, yeah, this is in bad shape. It could break down and really go down for years. All we saw were negatives of the variety that said, yeah, this could go down for several months. Yeah, and the case of silver, really, the sell-off, if you look at the first sell-off in silver after the high in early August, you dropped from nearly 30 to about below 22 within, I think, a month or so of the high. And since then, silver's been living mostly in the 25 area, well off that low that occurred right after the high. So it hasn't even trended down. It's just gone sideways. Looks like a big flag to me. So we don't understand, even when you look at a price chart, how you can be bearish long-term on gold. And when we look at our momentum indicators of gold and silver, there's not even any trend structures that have been built to break through. And unless you have something, like I said, unless you have a structure to break, you're not going to break the trend. And there's no momentum structure. There's no like multi-point uptrend line or flat floor that we've been using that breaks through. They don't exist on the long-term momentum charts of gold and silver. Therefore, even at the outset, we dismiss the decline as that of being a corrective decline, not a trend change decline. And we think the correction's over. We think now the only issue is at what rate does the upturn really pick up speed again? And what we're looking for is, frankly, an event for gold that we had back in July of last year. We broke out our annual momentum, and silver broke out at a price of $19.48, which was before it even took out the prior couple highs on price. It took out a massive multi-year ceiling on annual momentum. It went up 50% in 3 weeks. Gold's not done that in the entire move it's had since the 2015 low. It's gone up in strong layers with zigzags. And still no difference. We haven't seen that type of behavior. We suspect there's going to be a point that gold will trigger something that we can identify. And we're focused on that right now. That when it goes back up through it, probably before you even get back to the highs, where gold will suddenly do a quantum leap, something like what silver did last summer. And gold, instead of being 1900, is suddenly 2,500 so fast, people say, what happened? And where, it makes a statement, said, if you got off board, too bad for you. Because, if you didn't get back on board, you missed it. You're going to have to pay up to get back in. And I think that type of event is probably pending.
Sounds kind of like what Patrick Karim calls when we see a basing pattern like that, it's building energy for the next move up. Is that a fair way to say it?
Yeah, we saw it on the price charts of silver and gold, and they broke out after momentum did, but still you could even see it on price. And what we're looking for now is on momentum to find something that looks of the starting gate quality. When you open the gate, you get a flush. You don't get an arm wrestling match. You get like a light switch as occurs. And I don't know that it depends on some external factor. Like I said, gold, I think, is a leading market. It doesn't need the dollar to implode, although, that might happen coincidentally this time. Probably, I think, watch the T-bonds, because if we get that action in T-bonds and inverse in stock market, that might help gold. But I suspect it's going to be a technical triggered event, and we're looking for that intently right now, for that spot where gold goes from, goodbye. I congested, I pulled back. If you got out, we're gone. What are you going to do now? And I think that's going to be the shock effect for a lot of people who lightened their positions or became doubters.
So the last time we spoke, Michael, was in early January, which was before the silver squeeze. So did that amount of demand and exposure coming into the market change the way that you look at the silver market in any way, shape, or form? And I was wondering if you look at if silver typically leads these moves in gold, or if gold will move first and then silver will follow.
Gold usually leads. Well, sometimes silver does lead. You're quite right on that. I think it topped out earlier than gold did back in 2011. But silver vastly underperformed gold, as we all know, from 2011 through summer of 2020, when it broke up through our annual momentum number, 1948, and shot up to near 30. At that point, when silver broke out on its own annual momentum, its spread, measuring silver versus gold, also broke over an annual momentum structure at the same time. So the spread chart itself, which again is just merely silver versus gold measured versus the 3-year average of the relationship, it also broke out at the same time. And if you'll notice that while gold has pulled back, silver's gone sideways. Well, what that means is the spread has continued to advance favoring silver because gold has deteriorated while silver's basically held its own. And this is also reflective in the silver miners versus the gold miners to some extent. Like if you look at an SIL chart, silver major miners, or SILJ, the junior miners, heck, the silver junior miners are practically at their highs of where they were last summer. And even when you look at like the XAU index, which is the oldest of the gold and silver mining indices that's around at the Philadelphia Stock Exchange Gold Silver Mining Index. It's not gold and silver, it's the miners again. They hold 30 symbols, mining symbols. And as it happens, of their top 10 holdings now, 6 of them, of those symbols, are ones that MSA, Momentum Structural Analysis, favors on a performance basis relative to the sector. There was any given sector, whether it's tech sector, healthcare, whatever, you're always going to have some symbols doing better than others. And so we look for that. So we make suggestions as to, well, you want to own this miner versus GDX, you want to own this silver miner versus that gold miner. And we're getting the same type of behavior in the silver miners versus the gold miners, where in general, we think not only is silver back to an outperformance mode, long-term versus gold, and now will be a leader going forward. It wasn't initially. Gold made its bottom first, but now silver's the leader. And I think that's a good sign, because usually when silver becomes a leader, regardless of direction, like on the downside in 2011, it broke down in relative performance. In fact, it led the top. Okay, well, it lagged on the upturn here, but now that it's become a leader, it's telling us, we have a fresh new positive background signal about the monetary metals. That is that silver, the poor man's gold, is now going to be the leader. And if you look back historically, gold keeps making higher highs. It made a high in 1975 at 200, then dropped. It made a high at $850 in 1980, then it dropped. Then it made a high at $1,900, et cetera. Made higher highs. Silver didn't. Silver basically peaked in 1980 at around 50. It peaked in 2011 around 50. We think if silver ever gets back to 50 again, it's going to blow that triple top out and probably go, and we base this on some long-term momentum and logarithmic scale charts of silver, to somewhere around $200 an ounce. And at that point, silver will then actually be catching up on a real long-term basis to what gold has been doing, which is to say making higher highs each time. Silver's got a catch-up to do, and I think silver's catch-up could be quite dramatic on a percentage basis. And so we watch gold, it's the mama, but silver is highly likely to vastly outperform gold going forward.
So I want to go back to something that you were saying, Michael, about picking, let's say, the miners that are going to outperform those indexes. Are there particular things that you try and identify in those miners to that make them more attractive to you? Strictly
technical. Just like everything we do. I don't want to know anything about the Pan Am silver, for example, or Hecla mining versus some gold. I don't want to know who's making more money or who's got more ore. I really don't. What we do is we do spread analysis. We also do technical of their price action. So we look at some of their long-term momentum charts. But really the better way to make that judgment is strictly spread analysis, where you take the price of Hecla silver miners and you plot it as a percent of the price, the current price of, let's say, GDX, which is composed of both gold and silver miners. And when you plot the spread, and we also run momentum of the spread as well to make sure that the momentum is agreeing with the spread chart is saying, and you see a spread chart that, let's say, is basing. Maybe Hecla goes up and down versus the GDX over a year or two, or Pan Am silver, or whatever miner we might be looking at. And it's really sort of going sideways for a couple of years in terms of its relative performance. It's sort of holding its own. So if GDX has doubled, then so is that miner. So it's on par to par performing. What we look for is breakouts of these type of bases. Or if we've got a stock that's been trending up on a relative performance basis, you could see it on the spread chart, just like a price chart. But it breaks the trend and goes down. Then that chart goes, instead of outperformer, we shift it to either par or underperformer. We take it off our list. And so that changes, over time. Just like in the tech sector, any sector, you're going to have outperformers that last for a couple of years, and then suddenly, they're not outperformers anymore. So it's something you have to constantly monitor. But no, we do not pay attention to the fundamentals. We have a lot of friends who do, but we really don't. We like our ignorance in that regard.
It's an interesting way to look at that market, Michael. I want to turn to something completely opposite, let's say, and another quote from one of your letters saying that MSA has warned many times in recent months, as private cryptocurrencies gain in stature and acceptance, central banks and governments will be compelled to corral, inhibit, or otherwise regulate these alternative monies into a corner. You and I spoke before we hit record a little bit about the implications of this. So how do you see this playing out in the bigger picture for Bitcoin?
Well, we track Bitcoin solely via the CME, Chicago Mercantile Exchange futures, not the various cryptos that exist. We like a reliable database, and they put out daily, and we can do daily, weekly, monthly charts of CME Bitcoin. Okay. When futures began trading in December of 2017, Bitcoin was at $20,000. That's because the cash market had driven it up there. And I just happened to have a memory, because I was in the futures markets back in early 75. I got hired by Hutton in the commodity division of Hutton. And Gold COMEX my boss was the chairman of the COMEX as well. That's where silver and gold, where silver was trading and copper, and then gold started trading. Well, gold had been in a cash bull market from like 20, 30 bucks an ounce for several years, gone up to hit 200 as soon as it started trading on the COMEX. On midnight, December the 31st of 1974, early morning, January 1st, 1975, it was at its peak. And it just dawned on me, I had to do some measurements. So I used the cash Bitcoin at that point. And sure enough, it was a bubble in our estimation. And we said if it hiccuped, it was going to collapse. And we thought Bitcoin then at 20,000 would go to 5,000. Was our objective. It went to 3,600. It took it a couple of years. Most of the collapse came pretty quickly, but then it leveled off for a year or two at 6,000 and finally went to 3,600. At that point, momentum then turned up when it got back over 5,000 again. And basically, we've been technically bullish using long-term metrics, not short-term, on Bitcoin since then. There have been a lot of sell-offs that have been impressive, but basically the long-term stuff says, no, sell-off didn't really break the backbone of this emergent bull trend. We're in jeopardy right now. This week's action puts it in jeopardy based on our metrics, momentum-based metrics. But you mentioned the fundamental there. And if you just pause and think about it, okay, the central banks of the West control their money units, and they like to think they control interest rates. But if all of a sudden the private money units start popping up, cryptocurrencies, and people actually start using them, in exchange and ignoring our currencies, that undercuts the potency of their policy directives, their policy intents. If 5% of transactions going on in the world are crypto, and then it's suddenly 10, and they can see, oh goodness, what if this gets to be 15 or 20? Then suddenly they're made less and less potent, the central banks and their treasuries. And so what we expected, and we said this a handful of months ago, don't be surprised if you hear from authorities comments that are negative about cryptocurrencies, Bitcoin. And sure enough, Christine Lagarde of the ECB spoke, I think it was in late February, early March, using criminal type terms in defining Bitcoin, like it was a negative activity that is suspicious. You don't make a statement like that in public unless you have intent, particularly when you have power. Okay. A week or two later in testimony, Janet Yellen made a similar statement about Bitcoin being used for money laundering and all that, and nothing positive, all negative. You don't make statements like that unless it's implied intent to do something at some point in time. I don't think they can ban cryptocurrencies. It's too pervasive. But I do think they can take steps, or at least bully that market verbally and take some kind of, have hearings and that sort of thing that will cause the high buyers of Bitcoin, the bubble chasers now, to have pause and to worry about, my God, what can they do to us? And even just the fear of that new variable could help cause a technical breakdown. Our technical work says, and we adjust this every week, what we've done is we've measured Bitcoin futures in relation to a 40-week moving average. And it's not the average itself that matters to us. Frankly, that average is way below the market. If you ever went there, it'd be a crash just to get there. But it built a structure, meaning when you look at the momentum charts, where it made a peak back a year or two ago in relation to that moving average. So it got to like 120% over that average, and then dropped back down, and then blasted through that pie in the recent strong surge. So momentum was fully in agreement with price. It was exploding above a prior major high. The recent pullbacks we've seen in price on Bitcoin have been trivial and been at very high levels, not anywhere back near some old high. But on our momentum charts that sat back on that old high and used it as support, to where we can now draw a structure such that if you close out this week at 59,000 on the front month future of Bitcoin or lower, we're going to break that structure. And that number rises each week a bit because the 40-week average is rising. And frankly, the numbers at 120% over that mean. As I close any week at 120% higher than that average, I'm breaking that momentum structure. Now, it just so happens that this potential topping action by Bitcoin momentum is occurring at the same time that we're getting more and more attention and focus on these statements that are coming out. So it just may be that this, what we expected from the central governments and their banks, could become the pinprick that causes Bitcoin to have a serious decline. We're not talking about a collapse off the page like occurred, after 1917 through 2017, 2019, but something serious enough to where it would cause a lot of pain. So we're very cautious on Bitcoin right now. As far as correlations between what Bitcoin is doing and gold, for example, which is a lot of talk about that, we don't have a firm opinion on it. We think it's way too early to try to draw conclusions about, well, money that would go in gold is going into Bitcoin. Well, maybe, maybe not. And maybe we'll find out if Bitcoin breaks, maybe some of that money goes to gold. I don't know. I don't have a bet on that. We treat them technically different. And right now we see vulnerability in Bitcoin.
Excellent, Michael. I think that's a very sober way to look at the Bitcoin market. As we wrap up here, is there anything else you'd like to share with our audience?
No, just I think the main point is you've got to, don't just look at your market. Let's say you're in the government debt market. Don't just look at that. Look at gold, because gold is technically very well correlated to what T-bonds price is doing, T-note, TLT. Look inversely at the stock market. You start to see the stock market, drop 5 and then 10% off its highs, and you see T-bonds suddenly shoot up 10 points off their lows. It's not a surprise. So don't just look at your market. Look out the side mirrors. And that's why at MSA in our reports, we're focused on all 4 asset categories. And right now, frankly, the 3 that we've been focused on most, gold market, debt market, government debt market, and the stock market, are correlated fairly tightly, inversely or coincidentally. But also the dollar is now approaching a level, not on momentum, because it's already broken on momentum, as far as we're concerned. There's no issue about the momentum direction the dollar is going. It's down. The issue now is the price chart level that the price chartists have made a religion out of, and that's just below that, around 89 on the dollar index. We think if you get back there again, they're just going to give up, and you're going to implode through that level. So suddenly you could get noise out of what's really been a percent-wise unvolatile market for the last 5 years. The dollar's been stuck in about a 9-10% range, up and down. That's going to change. So all of a sudden, all 4 major asset categories could get very noisy. And therefore, even if you're focused on one, look at the other three at the same time.
Excellent advice there, Michael. Of course, I encourage everybody to check out your website, olivermsa.com. And also, you guys have a Twitter, Oliver_MSA. Your reports are very detailed and provide a lot of great information. Michael, thanks very much for your time today.
Thank you, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.